Let's widen the picture out and go macro. For that, I'm joined now by Scott Ladner, Chief Investment Officer, Horizon Investments. Scott, thank you so much for joining us this afternoon on a happy Friday. We'll call it Happy Friday. Let's talk about, we haven't spent as much time on this today, but let's kind of talk about the Fed and the direction the Fed is going. Next week, it'll certainly be in focus where we have the PCE numbers by the end of next week. The Fed has often talked about being data dependent, and we've had this timeline stretched about the expectations for when rate cuts could come. What's your view on how the Fed has been positioning itself?
Yeah, Dan, hey, and happy Friday to you as well. Look, the Fed is intentionally being pretty cautious right now because, frankly, they have the ability to be pretty cautious and conservative right now. And we still have a labor market that is, while weakening, still strong. So we're going from like a 9 out of 10 strength to a 7 out of 10 strength. Still pretty strong overall. An economy and a consumer that is still, also very strong. Corporates are all termed out on their debt, so they're not really getting hurt too bad. Profits are accelerating pretty nicely right now. So all in all, we got an economy that's pretty darn good. And so the Fed is taking the opportunity to kind of talk back the market in terms of timing of this first rate cut, because in their minds, that this is very separate from the ECB. The ECB basically did a one and done. They kind of talked themselves into a cut. The market priced it in, and they sort of had to deliver it. This is something the Fed doesn't want to have to do. They've made it pretty clear that once they start the cutting cycle, once they make that first cut, they really want to make it a series of cuts after that. Kind of want to get back to that Greenspan measured approach in terms of rates, rate management. So we think that the timing of that first cut is very important to them. It's going to be very important to the market, and so they're just taking their time to get there right now.
What's your base case for when you see them making the first cut?
We kind of vacillate between September and December, frankly. I wake up one morning and I think September. I wake up the next day and I think they're not going to try to mess with the elections, so they'll just go December. Mm-hmm. If you put a gun to my head, I'd probably say December for the first cut, just because I think there is a little bit of political calculus that does go on at this supposedly apolitical institution. And so I think December is probably a little bit more likely. But to me, it's like a 55-45, and I don't think it really matters that much. And so if it doesn't really matter that much, I think they'll want to avoid the appearance of political motivations with that first cut in September.
And then you talked earlier about this being a cautious Fed. Do you think that caution is warranted?
Yeah, look, I think it's available. It may not be warranted, but it's available. And so they could certainly start cutting around now. Inflation, the book on inflation has already been written. We're just reading it right now. It's obvious where it's going. We are going back towards 2%. Inflation is basically under control at this point, and is driven importantly by wage dynamics and by productivity dynamics. And those are pretty firmly in place right now. So whether they started in July or September or December doesn't matter a ton. But we think they're kind of being smart to press pause as long as they can. If they had rates here for 12 months from now, this economy will start to get hurt. It's not going to be immune from high rates forever. But they are taking the opportunity while it's immune for high rates for right now to take advantage of that and just take a cautious tack.
When you talked a little earlier about the ECB's recent moves, what do you think the Fed should be taking away from what the ECB's path has been?
Look, don't talk yourself into a corner. So forward guidance is well and good, and it's an important policy tool right now that's not going to get walked back anytime soon by any central bank. But the ECB really did kind of talk themselves into a corner in terms of saying, we're going to cut in June, guys. We're cutting in June almost no matter what. And inflation data was not terribly supportive of a cut in June over in Europe. Europe is, though, more cyclical. They are more tied to rates. And so it is actually important for the ECB to start getting rates down because that economy is slowing. It's a very different makeup over there than it is over here stateside. But talking themselves in a corner and basically having the market completely price in a particular move when the data are a little bit against it would be a situation the Fed desperately wants to avoid. And that's, I think, one reason why we had a little bit of a hawkish howl at the last press conference.
And then is the way the market pricing the path of rates, does it seem to be, kind of seeking a cut sooner rather than later, like such as a September scenario? And is that positioning warranted from your view?
Look, I think the market has kind of come pretty close to in line with what the Fed is thinking. Yeah, I mean, look, the market is pricing a September cut, but it's not wildly pricing a September cut. It's and it wouldn't make a huge change to asset markets or the way we're positioning our portfolios, whether it's a September or December. And so I think that the Fed and the market have basically come into more alignment in terms of their views and the way that this is getting priced right now than really any time over the last 6 months, and certainly much more in line than we were at the beginning of this year.
Let's talk about some of the bifurcation that we see when we look at, so for instance, some of the data points, some of the economic data. We're seeing some softening for consumers, but even though you're seeing some fatigue in equities recently, the stock market is still holding up strong. What do you think is kind of behind the bifurcation, and how do you balance your exposure to be defensive if something rolls over?
Yeah, look, the bifurcations are kind of coming thick and fast right now, and we are seeing there's a big difference right now between the low-end consumer and the high-end consumer. There's a big difference between big businesses and small businesses, both in their outlook and actually, frankly, how they're performing. High-end folks are doing really well. They're getting 5% yields on their cash balances. That's really helping out spending on the high end. Low-end folks are obviously more exposed to higher rates, more exposed to credit card rates, more exposed to payday loan types of things. And those are really being crimped. So we are seeing some stress in that low-end consumer right now. It's not terribly concerning to us currently because the low-end consumer isn't the thing that really drives the bus in terms of economic spending. It's really the middle consumer, and we've not seen this spread into the middle of the consumer yet. And a high-end consumer is actually doing fantastic. But that's the consumer side. When we get to the business side, there is some politicalization about how small businesses and large businesses feel. Small businesses tend to be a little bit more conservative, so they tend to respond, more positively when, frankly, Republicans are in charge. But that be it as it may, small businesses right now really their sentiment is frankly in the toilet. It's really, really bad, and their outlook on their own business is really pretty bad. And that's, it has not translated into bad CapEx, hasn't translated into firing people, it hasn't translated into business actions right now. But something is that, it is something that we're watching in terms of small business sentiment being really very poor relative to the overall economy. It's doing pretty darn well.
And then I got to ask you, so what seemed to work for a lot of investors this year is really growth, especially, and not so much the value plays. Are you sticking with large cap growth? Is that the best case scenario right now?
It's a little bit boring, Dan, but we are. We're not adding to it right now, frankly. This is a place where I think you can continue to hold onto it and stay somewhat overweight the large cap growth trade. Look, it's where the fundamentals are being delivered. I heard you with your last guest. This is the part of the market that's delivering revenue gains. This is the part of the market that's delivering margin expansion. This is the part of the market that's delivering EPS growth that better than any other part of the market. So this is not your daddy's Nasdaq from 1999. This is these are companies that are doing all the growth. They are the atlas of the market right now, but it's a supported atlas based on the fundamentals. And so this is not an area that you want to get short or be underweight right now. We just think that that there will be an opportunity to rotate into some of the laggards like small caps and financials and some of the value names. But that timing of that is probably going to be dependent on the Fed starting their rate cutting cycle. And lower rates that were to follow after that. Until you get there, it's going to be tough for the fundamentals, especially on small caps, to improve relative to their large cap brethren.
Yeah, I've noticed that with small caps especially, they've had difficulty kind of gaining the momentum that we've seen with the larger caps and just kind of the tried and true play that's been working this year. Scott Ladner, Chief Investment Officer, Horizon Investments. Thank you for your time today, Scott.